This is Financially Fit Radio with Cory Sickles from Safe Harbor Wealth Advisors. Retirement isn't just about saving, it's about having a strategy that helps you navigate market ups and downs, combat inflation, and secure the future you deserve. That's why Financially Fit Radio is here to tackle your biggest financial concerns, share actionable strategies, and help you move toward your retirement goals with confidence. And now, here's Financially Fit Radio with Cory Sickles.
Welcome back to another episode of Financially Fit Radio. I'm Cory Sickles with Safe Harbor Wealth Advisors. If you would like any information that we discuss on today's show, feel free to give us a call at 614-760-0670, or you can always visit us online at safeharboroh.com. While you're on our website, make sure you check out that radio page. You can catch up on previous episodes. Also, you can also subscribe to our program via podcast on Apple Podcast, Amazon Music, or Spotify. Also, feel free to watch today's show on our YouTube channel. Just type in Safe Harbor Wealth Advisors. You can watch today's Financially Fit Radio show, previous Financially Fit Radio shows by just clicking on our playlist. You can also subscribe to our YouTube page as well and be kept up to date with all the video shorts that we put out. We put about 4 or 5 video shorts out a week on different types of financial topics. You know, we're really here to help and guide you to have the best retirement that you can. So I would highly recommend, you can always schedule a complimentary, no financial obligation meeting with us. Again, we're here to help and guide you to make sure you have the best retirement that you possibly can. Again, our website, safeharboroh.com. Well, today we're going to talk about short-term versus long-term and how can you actually protect your money smartly. But before we dive into that, let me introduce to my co-host this week and every week, and that's Tony Shore. Tony, how are you today?
I am doing really well. Fantastic, I would say, Cory. And just been doing a lot of traveling. I really enjoyed hanging out with you there when we recorded in person there in Columbus, and that was fun. But I've been busy, really, really, really busy with dealing with my parents. So now both my mom and dad are in long-term care. My dad had to move him over from assisted living into long-term care, and we're going through that process. And as you know, there's a lot to that, and still getting the financials sorted out with what he's going to owe and what the state might cover and what'll be left and how to protect it. So I just encourage our listeners and viewers out there, plan ahead with your parents or for your own plans. The further in advance you plan to protect your money, if you want to leave money for your children or grandchildren, it has to be protected before you get to at least 5 years before you go into long-term care, because there's a 5-year look back and they can go after that money. So it really makes sense. And I know you and your team there help people with their estate planning as well. And I think that's great.
Yeah, you know, Tony, you really can never plan too early. Obviously, I think a lot of, our generation that, the Gen X are dealing with a lot of baby boomers like your parents that are now going into those facilities, which means we have to help take care of them. Obviously, at some point in time, it could be you and I or, our spouses or anything like that as well. It's something that you really should be able to plan for. The nice thing about a plan is you can always change it. But if you don't have a plan in place, you're kind of scrambling around trying to figure out what you should do.
Yeah. Yeah. And that ties into what we're talking about today. But first, how have you been, Cory? What have you been up to?
Been traveling. It seems like I've been traveling quite a bit. I'll be up in Minneapolis, this week. I'm going up there for an advisor event, just to be able to learn about investing, with graded investments as well. So that's always good to be able to hear, expert people talk about different types of topics. But I think more importantly, it's a good time for me to sit down with other advisors to find out, what's working for them, what changes are they making within their companies. And but it's always good to be able to sit down with other advisors and just kind of brainstorm about different types of, issues, concerns that, that everybody has.
Well, and I know you're going to be hanging out and listening to getting some advice from Brian Belsky while
Yes.
you're up here. And Brian is the chief investment strategist and leader of the investment strategy group for BMO Bank, which is one of the big banks in North America.
Yep.
And based in Montreal. But BMO is a huge bank. And Brian Belsky's a leader in the financial world as far as investment strategies. And you'll be picking his brain. He'll be talking to you and some of the other top advisors from around the country. And some of the key players in that industry will be there. A lot of people that we see on Fox Business News or CNBC, really Wall Street Journal. So it's a big deal. And I know that you, other advisors look to you for advice on how you're helping your clients, and you usually speak and present to the other advisors. So I think it's a great opportunity, and that's the Elite Advisor Forum up there in Minneapolis. So that's great.
Yeah, looking forward to it. I'll be up there basically until Friday, get back Friday night.
Sure.
And then I drive over to Indianapolis for Saturday.
Oh, what's happening? Refresh our memories. What's happening
for the old Jester Cup. So
the Jester Cup, one of the premier golf tournaments in the United States.
Yeah,
the Jester Cup, and it's the Jester family versus Team USA. And of course, our listeners, viewers, myself, I think we're all supportive of Team USA. Who wouldn't be, right?
Yeah. Well, on next week's show, I'll be able to provide everyone an update on whether we won the cup or we lose the cup.
Okay. I can't wait to find out. And I know you've been doing some video clips to promote the event, and maybe a little bit of taunting. I don't know.
Judge for yourself. You can check out my Facebook page, my Instagram page, my YouTube page. Whether it's me personally or whether you want to check out my Safe Harbor Wealth Advisors pages as well. They've all been posted. We're leading into the last week. So I've released about 15, 16 videos in a row here.
Yeah.
One daily.
I know you got interviewed by Pro Golf Talk Network host Dr. Tony Driver.
Yep.
And he interviewed you. Those clips are up there. I love those.
Yep, they're up there, Tony.
Your four. Didn't you just post your 4 types of putting?
I did. So you do want to vote on how we should react if we hit a big putt?
Yeah,
go out there today and vote.
The 4 putting reactions, right?
That's right.
I think is that is a funny video. I encourage our listeners, and if you want to smile, you want to vote on how Cory or the team should react based on the putt. I think that's a fun one. Go to Cory Sickles' Instagram page, or is it on the Safe Harbor YouTube page as well?
It's on the YouTube page, and it's also on our Facebook page as well.
On the Safe
Mine
Harbor
personally, as well as Safe Harbor Wealth Advisors.
That's awesome. That's awesome. Now, today we're talking about short-term versus long-term investments and planning, how to protect your money smartly. That's always the goal, right? And that's what you do to help your clients. So how can our listeners out there do that? Where do you want to start? What's the first thing that people think about, or that you might think to protect your savings or investments?
Yeah, obviously, I think when people think of safe investments, they think about putting money in the bank, right?
Sure, in the bank, yep.
And obviously, if you put it in the bank, you're going to have, FDIC insurance up to $250,000, per depositor. If you put it in a checking or savings account, interest rates on that money could be low, so you need to be able to check that depending on how much money you're actually putting in there.
Or non-existent, depending on how much you have in there.
Yep.
But even if you have a lot of money in an interest-bearing account in the bank, just a checking or savings, even if it is interest-bearing, it's not going to keep up with inflation, right?
It is not going to keep up with inflation. And even if you kind of look at the next option, Tony, which would be like high-yield savings accounts or certificates of deposit, right now, those are paying probably somewhere between 3.5%, 4.5%, depending on the length and term that you want to be able to do. But the one thing I would say is, we're sitting here, we're actually recording on Monday, the 15th.
Yeah.
The Fed's going to meet this week.
Yep.
Speculation is they're going to drop interest rates. And if they drop interest rates, you're going to also now see high yield savings accounts and certificates of deposit, lower their rates going forward as well. So it's something to kind of look at as interest rates do drop. These type of accounts do drop as well, and it's going to be tough to keep up with inflation.
Yeah, and you mentioned certificates of deposits, or they're called CDs. Of course, I have a huge CD collection, but not certificates of deposit.
Right.
Music. I'm old school. But CDs, a lot of our listeners out there probably grew up in a time when, our parents or grandparents, the boomers, were putting a lot of money. The CDs was a popular way to earn interest on your money and get more interest versus just a standard bank account. However, and the rates have been pretty good, but they're starting to go down already. And if they drop interest rates, my problem with CDs right now would be, if we think interest rates are going to be lowered, which everybody says they will be this week, when your CD runs out, to get the high rates, the term is pretty short. Like, you can put it into maybe a 12-month CD. Some of them are 9 months, maybe 18 if you're lucky, to get the highest rate. But you can't do a 5-year CD and get a good rate right now, because they're not going to give it. And then when that CD term runs out, the next rate, they'll automatically put you into another one after that at a lower rate if you don't change it up or take it out or start a new one, right?
That's exactly right. So I guess right now the word I would say is caution.
Yeah.
You need to make sure you see what the Fed does, see what the certificates of deposit, what those rates are going to drop down to, which means you're going to have to look at other alternatives. And usually when interest rates go down, Tony, one option out there is to actually start now looking at, treasuries, bills, bonds, and things like that. The nice part about that is that's where the money kind of flows, which means you should see a little bit better, higher of a payout. I think a lot of people.
You mean with treasury securities?
In bonds, in general.
Bonds, yeah.
Bonds especially. I mean, I think a lot of people thought bonds were a safe investment. And I think, 2 or 3 years ago, we found that out when bonds were down double digits. But bonds have kind of rebounded back now. They're probably, when you look at our portfolios this year, they're actually outperforming what you can make in a CD. Obviously, we can't guarantee that going forward because you can't have market loss within there. But, right now they are paying a pretty decent dividend as well.
Right. So we're talking about short-term safety. In other words, cash or nearly liquid assets, not 100% liquid, but short-term investments that can protect your money. So you've mentioned just a standard bank account, high yield savings, CDs, treasuries. What are a couple of others where you can get some return on your money, but you still get principal protection?
Yeah, one of the things that, a bank has a CD, right? But when you start working with like insurance companies, they have what they call a MIGA, and it's really just a short-term or multi-year guaranteed annuity, right?
Right.
And right now you can get like a 2-year. It's probably a little bit over 5%.
Yeah.
Obviously, if rates drop, those will drop as well. Right now, they're outperforming probably a certificate of deposit or a high yield savings account right now.
They're usually at least a percentage above most CDs. So a MIGA works exactly like a CD or very similar, but it's through an insurance company rather than the bank. That's one of the only differences. But a 2-year, if you can get a 2-year at 5% and it locks that 5% in, you're probably doing pretty good because interest rates are going to lower.
That's right.
If you get it in, if you get that in there, if you get one like that before they lower interest rates, you're doing good because you'll have 2 years of guaranteed 5%. And that's guaranteed based on the claims paying ability of the issuing insurance company, which is a good thing if you're working with someone like yourself, because you only work with the A-rated or top-rated companies. And basically they're insured up to $250,000 per person as well. It's just through the state rather than through the federal government. So, it's kind of people say, oh, I like that FDIC insurance. Well, there are protections with an insurance company as well.
There are.
Yeah, they
And
have to have that money on hand and more. So if you give them your money and put it in a MIGA, they have to have that plus a certain, I think, an additional 5 to 10% on top of it in an account for you, so you'll get your money.
That's correct. And one of the biggest differences between it, like a CD or any type of, I'm going to say, bank account versus like a MIGA, Tony, is let's just say you have $100,000 that you put into a CD, and then say that generates 4%. That's $4,000 of interest that you're going to make off of that, right?
Right.
But you're also going to get a 1099 at the end of the year for that $4,000 growth.
Right.
With a MIGA, the nice part about that is you actually don't get you actually don't receive a 1099 until you actually cash that out. So if you go into a 2-year CD, you might be able to delay some of your taxes for 2 years on what you're actually going to pay on that growth. The other side of that is, let's just say, then you rolled into another MIGA 2 years later. When you do that rollover, you're still deferring the taxes.
So you're able to defer taxes with an annuity or with a MIGA, whereas a CD, and I didn't know this because my dad put some money into a CD, and I helped him do it. And I tried to talk him into a MIGA, but he wanted the CD because that's what he grew up with, right? That's what his parents had it in. So when he inherited the money from his dad, from my grandpa, he put it into a CD, and then I'm helping him with his taxes, and we get this 1099. We get a tax form, and I'm like, well, this doesn't come due for another year. Why are we getting taxed on the earnings before we even get a chance to access it? So, that is a downside to a CD. I mean, there's give and takes with both MIGAs and CDs, and you have to look at the pros and the cons. A MIGA isn't right for everybody, but it may be better for some people than a CD. Some people insist on that FDIC insurance. They think that that's the only way their money is safe. And that is not, you don't get FDIC insurance through an annuity or a MIGA. But if you can get around that, you might be able to get a higher interest rate.
Yeah, that's exactly right. So, when you look at a MIGA, you can do a 2-year, or 3-year, or 4-year, or 5-year.
Yep.
So those are multi-year guaranteed at whatever rate you get. Obviously, if you maybe want to go up, one more, option would be as you get into what we call a fixed indexed annuity. We talked about them on the show quite a bit.
Yep.
Now you can actually get, now you're into annuities. Many could be a 5-year, it could be a 7-year, it could be a 10-year. The nice part about a fixed indexed annuity is obviously you get to invest in the market, but if the market goes down, the worst you'll do is make zero. However,
so you're not going to lose principal in the market.
That's correct.
You don't have
lose any principal.
Yeah, if the market goes down, you don't participate in the market loss. You only participate in the upside. The con is you don't get all of the upside, but you're gonna have
some type of caps on what you can actually make, but you can invest in the S&P 500 if that's what you want to do, and a lot of them have a lot of other different indexes. But it's a good way to be able to protect your asset, probably outperform. I'm going to say probably. I mean, there's no guarantee that you'll make anything off of it based upon the market, how the market performs. But it gives you a better chance, I think, long term to be able to actually beat what you can make in the bank.
Oh, for sure. And that's why fixed index annuities are so popular with the baby boomers that have been retiring, because you get the principal protection, you get to participate in market upside, and there are little to no fees on these types of accounts now. The only thing I would add is we've been talking about short-term safety, and a lot of annuities are considered longer term.
Yes,
so you don't have the liquidity that you do in some of the other things we talked about. Obviously, with a CD and a MIGA, you don't have liquidity. There are early withdrawal penalties if you take it out before the end of the term with those.
Sure.
Typically, the terms are a little shorter than they would be for most fixed
Yeah.
index annuities.
Yeah,
right?
I mean, a MIGA is going to represent, you can do a MIGA just like you do a CD. When you get into the fixed index annuities, now you're looking at probably 5, 7, 10 years. You want to keep that money in there. Most of them do give you a 10% penalty-free withdrawal every year if you want to be able to do that.
Oh, that's nice. Yeah.
But it's a good way to be able to protect your assets.
Yes.
Obviously, now when we start talking about, now we're getting into that long-term safety. Now, obviously, what you want to do is you want to have a diversification, right?
Yeah.
You want to be invested in stocks, bonds, maybe some alternatives. I'll talk about alternatives here in a second. But the one thing you don't want to do is, you hear the phrase all the time, you don't want to have all your eggs in one basket. And really what we're talking about is you want a little bit of safe money, which could be like a MIGA or it could be a CD. Now you're going to be invested in stocks and ETFs. One of the things that we have that are one of the investment tools that we have that's very popular with for our clients, especially that are retired, is we have our buffer products that it can allow you to invest in the market, have some type of upside, cap, but the most important part is you have different types of what we call buffers or protection. So, for example, Tony, we have a 100% buffer. You can invest in the Dow Jones and the S&P 500. Right now, you have 100% for an 18-month. Can't lose any money, from the market downside. But you can make up to like 12.7% over that 18-month period, depending on how the market performs. Again, if it's negative, you don't lose any of your principal. But it's a good way to be able to invest in the market, but have protection. Because as people age, the one thing they don't want to do is have a lot of money at risk. So this is a good way to get a decent return, still be invested in the market. We also have other buffers, Tony, where you can be more aggressive, right? You might have a 15% buffer, which means you don't lose any money unless the market's down over 15% over a 24-month time frame. And some of those are uncapped, which means you can kind of make whatever the Dow Jones or S&P actually performs during that time. But, obviously we can't guarantee anything off of that like we can a MIGA or like we can, a CD or anything like that. But it gives you the opportunity to try to make more money than you could actually by having your money in the bank or in a MIGA or even a fixed indexed annuity.
Sure. And this is a little more long-term. So obviously diversification, investments, what else?
The other part of all this type of stuff, when we start talking about safety and things like that, you talked earlier about your father and mother, being in long-term care facilities. So obviously you need to make sure that you have whether you need a will or whether you need a trust and some estate planning, but you need to make sure you have all your legal stuff in order, because that's a good way to actually protect your nest egg. Make sure it goes to where you want to. If you want to be able to plan for long-term care with an irrevocable trust and things like that, that's something we can definitely sit down, discuss, and find out what's the best solution for you.
Yeah, there you go. I think that makes a big, big difference. And so money you need in like for the first, 1 to 3 years, keep that safe and liquid, and 3 years plus that can be invested for growth, right?
That's exactly right. I mean, that's really what you should be doing, is making sure you're diversified from a standpoint, not only from how you're invested, but from a liquidity standpoint, and from a safety standpoint. I mean, as we age, when you're in retirement, you're going to need to make sure that you have income coming in, probably more than likely from your investments. And that's where that short-term money is going to come from.
Yeah. I think that's really important. Well, we're almost out of time here. It flew by. How can our listeners out there get a hold of you, Cory?
Yeah, for our listeners out there, you can give us a call at 614-760-0670, or you can always visit us online at safeharboroh.com. We have 2 locations here in Columbus, one in Dublin, one in Easton. All meetings are complimentary. There's no financial obligation. So again, just give us a call or visit our website at safeharboroh.com.
Thanks, Cory, and thanks, listeners and viewers. That does it for today's episode of Financially Fit Radio with our host, Cory Sickles.
Thank you for joining us for Financially Fit Radio. Don't head into retirement without a strategy that addresses both income and taxes. For more information, please contact Cory Sickles at Safe Harbor Wealth Advisors at 614-760-0670 or visit safeharboroh.com now. Join us again soon for another episode of Financially Fit Radio.
Investment advisory services are offered by Safe Harbor Wealth Advisors, LLC, and SEC Investment Advisor. Insurance products and services are offered through Safe Harbor Retirement Group, LLC, an affiliated company. Safe Harbor Wealth Advisors, LLC, and Safe Harbor Retirement Group, LLC, are not affiliated with or endorsed by the Social Security Administration, the Federal Medicare Program, or any government agency. All matters discussed during the show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. Calling this number will direct you to a licensed sales agent.